Week 12 Financial Crisis and Economic Globalization. Asian Financial Crisis 1997 and its impact. The Asian financial crisis of 1997 was a monumental economic downturn that affected many East and Southeast Asian economies, originating in Thailand with the collapse of the Thai baht. The crisis quickly spread to neighboring countries, including Indonesia, South Korea, Malaysia, and the Philippines, causing widespread financial turmoil and significant socioeconomic repercussions. 1. Causes of the crisis. Several interrelated factors precipitated the crisis. Rapid economic growth in the early 1990s led to excessive borrowing, both domestically and from international markets. Many Asian countries maintained fixed or semi-fixed exchange rates, making their currencies vulnerable to speculative attacks. Additionally, financial systems in these nations were often poorly regulated, with inadequate oversight of banks and corporations. High levels of short-term foreign debt exposed economies to sudden capital flight when investor confidence waned. The lack of transparency and weak corporate governance further exacerbated vulnerabilities, making it difficult to assess the true financial health of institutions. 2. Sequence of events. The crisis began in Thailand in July 1997, when the Thai government was forced to float the baht, after failing to defend its fixed exchange rate amid speculative attacks. The devaluation of the baht triggered a loss of investor confidence, leading to similar currency devaluations across the region. Countries like Indonesia saw their rupiah plummet, causing skyrocketing inflation and plunging economies into recession. Stock markets crashed, and businesses faced insolvency as borrowing costs soared and access to credit dried up. 3. Economic impacts. The immediate economic impacts were severe. GDP growth rates plummeted. For instance, Indonesia's economy contracted by over 13% in 1998. Unemployment surged as businesses closed or downsized, and poverty rates increased dramatically. Currency devaluations made imports more expensive, fueling inflation and eroding purchasing power. Foreign direct investment (FDI) declined sharply as investors became wary of the region's economic stability. 4. Social and political impacts. The economic hardship led to significant social and political upheaval. In Indonesia, widespread unrest and dissatisfaction with the government's handling of the crisis culminated in the resignation of President Suharto after 3 decades in power. Social services were strained as governments cut spending to meet International Monetary Fund (IMF) bailout conditions, exacerbating public discontent. The crisis also heightened social inequalities, as the economic downturn disproportionately affected lower-income populations. 5. Reforms and responses. International institutions, particularly the IMF, intervened with bailout packages conditioned on implementing structural reforms. These reforms included liberalizing financial markets, restructuring banking sectors, enhancing corporate governance, and adopting more flexible exchange rate systems. While these measures aim to restore economic stability and investor confidence, they also led to short-term pain, including austerity measures that deepened economic contractions in the affected countries. 6. Long-term consequences. In the aftermath, Asian economies undertook significant reforms to strengthen financial systems and improve regulatory frameworks to prevent future crises. Countries diversified their economies, increased foreign exchange reserves, and adopted more prudent fiscal and monetary policies. Regional cooperation mechanisms, such as the Chiang Mai Initiative, were established to provide financial support and promote economic resilience. Dot-com bubble 2000 and its economic consequences. The dot-com bubble, peaking around the year 2000, was a significant speculative frenzy in the late 1990s and early 2000s, centered on internet-based companies known as dot-coms. Fueled by the rapid expansion of the internet, investor enthusiasm for technology stocks soared, leading to unprecedented valuations. Despite many companies lacking sustainable business models or profitability. 1. Causes of the bubble. Several factors contributed to the formation of the dot-com bubble. Technological advancements. The widespread adoption of the internet opened new avenues for businesses, attracting substantial investment in online ventures. B. Speculative investment. Investors, driven by the fear of missing out, FOMO, poured capital into dot-com startups, often disregarding traditional financial metrics. C. Venture capital. An abundance of venture capital funding supported numerous startups, encouraging aggressive expansion and high valuations. D. Media hype. Positive media coverage and success stories of early internet companies fueled investor optimism and speculative trading. 2. Burst of the bubble. By early 2000, the sustainability of dot-com business models came into question. As companies failed to generate profits, investor confidence waned, leading to a sharp decline in stock prices. The NASDAQ composite, heavily weighted with technology stocks, plummeted from its peak of over 5,000 in March 2000 to around 1,100 by October 2002. This dramatic fall erased trillions of dollars in market value and led to widespread financial losses. 3. Economic consequences. The bursting of the dot-com bubble had profound economic impacts. Market losses. Investors experienced significant financial losses as stock prices collapsed, leading to reduced household wealth and decreased consumer spending. B. Corporate failures. Numerous dot-com companies went bankrupt, resulting in massive layoffs and loss of jobs in the technology sector. C. Venture capital impact. The downturn made venture capital firms more cautious, leading to reduced funding for startups and slowing innovation. D. Reduced consumer confidence. The crash contributed to a broader economic slowdown, affecting sectors beyond technology as consumer and business confidence declined. C. Global financial crisis. 20,072,008 and responses. The global financial crisis (GFC) of 20,072,008 stands as one of the most severe economic downturns since the Great Depression, profoundly impacting economies worldwide. Originating in the United States, the crisis quickly cascaded across global financial systems, triggering widespread economic turmoil and necessitating unprecedented responses from governments and institutions. 1. Causes of the crisis. The GFC was precipitated by a confluence of factors. A housing bubble and subprime mortgages in the early 2000s. Low interest rates and relaxed lending standards fueled a housing boom. Financial institutions extended mortgages to subprime borrowers with poor credit histories, underestimating the risk of default. B. Securitization and financial derivatives. Mortgages were bundled into mortgage-backed securities, MBS, and collateralized debt obligations, CDOs, which were sold globally. These complex financial products obscured the underlying risks, leading to widespread exposure to toxic assets. C. Excessive leverage. Financial institutions operated with high leverage ratios, amplifying profits during good times, but exacerbating losses when the market turned. This vulnerability was compounded by inadequate capital reserves. D. Regulatory failures. Lax regulation and oversight. allowed risky lending practices and the proliferation of complex financial instruments. Rating agencies also failed to accurately assess the risk of MBS and CHAs, misleading investors. Global imbalances. Large capital inflows from countries with trade surpluses, such as China, contributed to low interest rates in developed economies, further inflating asset bubbles. 2. Sequence of events. The crisis unfolded rapidly. 2007 rising default rates on subprime mortgages signaled the beginning of financial instability. Financial institutions started to report significant losses from MBS and CDO holdings. 2008 The collapse of major financial institutions marked the peak of the crisis. In September, Lehman Brothers filed for bankruptcy, triggering panic in global markets. Subsequently, Bear Stearns was acquired by JPMorgan Chase, and insurance giant AIG required a massive government bailout to prevent collapse. Global spread. The interconnectedness of global financial markets meant that the crisis quickly spread beyond the U.S., affecting banks and economies worldwide. Stock markets plummeted, credit markets froze, and consumer confidence eroded. 3. Economic impacts. The GFC had profound economic consequences. Recession. The crisis led to the Great Recession, characterized by significant declines in GDP, massive job losses, and reduced consumer spending. Unemployment rates soared globally. Loss of wealth. Stock markets experienced steep declines, eroding household wealth and retirement savings. Real estate values plummeted, leading to widespread negative equity. Global trade decline. International trade contracted sharply as demand for goods and services fell, exacerbating economic downturns in export-dependent countries. Public debt increased. Governments increased spending to stabilize economies, leading to substantial rises in public debt levels. 4. Long-term consequences. Enhanced regulation. Stricter regulatory frameworks were established to prevent excessive risk-taking and improve oversight of financial institutions. Shift in monetary policy. Central banks retained lower interest rates for extended periods and continued to use unconventional tools to manage economic stability. Public trust and political impact. The crisis eroded trust in financial institutions and policymakers, contributing to political shifts and the rise of movements advocating for economic reform and greater financial accountability.